Hello, it's David Morgan with a weekly perspective for this week. Well, the big picture, of course, is always the debt markets or the bond markets. And bond yields around the world continue to climb, led by U.S. Treasuries. The 10-year Treasury yield is now at 1.76%, which is the highest level in 4 months. The 10-year yield has also moved above the 200-day moving average for the first time this year. And while all sovereign government bonds have lost ground over the last 3 months, the treasuries have lost the most. This is a hint, a strong one in my view, that's mainly due to increased rates expected probably by the end of the year. Time will tell. On the other hand, on the currency side, the US dollar hit a 7-month high, and many are waiting for confirmation that this new uptrend is intact. And lastly, before I move on to the precious metals, stocks basis the S&P 500 tend to be rolling over, and the idea of a further or possible sell-off in this month or later this year still is intact, even though it is an election year. And lastly, moving into the gold markets, this was written by a pretty good friend of mine, Frank Holmes. I suggest everybody read this article. Frank, as typical, put out a lot of great information for everybody. I won't read the whole article, but again, I think everyone should. He looks at buy signals, sell signals based on standard deviations, as you can see here, as I'm putting in the yellow. We are in this area here. Again, I'm putting the cursor there. And we are in the buy signal. I've suggested for the website members of the Morgan Report that we're certainly at a level, silver and gold wise, where we're probably going to pause, and probably a good place for people to add, or those that are not in the market to start. But as you can see from this, certainly one standard deviation does not mean it's the perfect place to go. It is a possibility to begin. We could go lower, obviously. And Frank addresses something in a slightly different way than I've done for years. In fact, one of my earliest articles, Engineering the Price of Gold, goes through this metric in a slightly different way because I look at it differently. But regardless, the idea is very much the same, and that is if you imagine waking up tomorrow and learning that all debt, this is world debt at 152 trillion, we're backed by gold. What would that mean? Here's the simple arithmetic problem, and you come out with $23,000 per ounce if gold were backing the debt by 100%. You have to realize that's current debt. That's not ongoing obligations that Professor Kutlikoff has talked about so many times. So is gold undervalued? And of course the answer is yes, it is from a fundamental standpoint. Technically, again, going back to what I said earlier in this video, we're not certain if this one standard deviation is enough to call it a bottom. I did an update for our website members suggesting that the commitment of traders basis the silver market certainly has not gotten to a level where I'm confident to say that the shorts have covered enough, although they covered 10,000 contracts last week, and certainly more than that because these reports are always a few days behind reality. Regardless, it looks as if there is more covering to do, which does not necessarily mean more price movement to the downside, although that is probably the most likely case. So that's a wrap up for this week. I'll be back with you next week.